everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 13 from the book How to Swing Trade by Brian Pezim. It has been created with the help of AI. The chapter is titled The Entry and the Exit. You can read the original post at samfury.com.
All right, let's dive in. Today, we're getting into the real meat of swing trading, the entry and exit strategies, and our guide, Chapter 13 of How to Swing Trade by Brian Pezim.
Always a good one.
Now look, we're not going to spend time on the basics, finding a trade, calculating risk reward. We want to talk about actually entering a trade. What happens? What happens when that price moves? After you've done your analysis, you've found the stock.
Yeah, you've got that perfect setup, and then the price does something unexpected.
Exactly.
Shows you a curveball.
So what do you do?
Well, think of it like finding that dream house, but then someone comes in and outbids you. You wouldn't just keep bidding endlessly, would you?
No way. You have to have a limit.
Exactly, a walkaway point. You have to know when to step back. And that's where the idea of a maximum acceptable entry price comes in. It's all about protecting that risk-reward ratio you work so hard to calculate.
Right. So you're not giving up all your potential profit just to get into the trade.
Exactly. You got to have some knowledge.
So even before you place that order, you need that clear boundary, that price in mind. But once you have that, how do you actually execute the trade? Limit order or market order? I always struggle with that choice.
Yeah, understanding the differences is key. A limit order gives you more control, right, over the price you get. But there's that risk that it might not get filled.
Oh, so you might miss the trade entirely.
Exactly. It's like saying, hey, I want to buy, but only if I can get this specific price or lower.
I see.
Now, a market order, on the other hand, guarantees execution. You're definitely getting it,
right,
but you might end up paying a bit more, especially if the market's moving quickly.
It's a trade-off.
It is. Mm-hmm. And knowing which to use, well, that really depends on the market conditions at that moment.
Mm-hmm.
How volatile things are and how urgently you need to get into that trade.
So in a fast-moving market, like a market order might be preferable just to make sure you don't miss out.
Right. You don't want to be left behind if things are taking off.
But in a calmer environment, you might have more time. You could use a limit order and wait for a better price.
Exactly, yeah. Try to snag a little discount.
I see. And what does Pezim say about this?
Well, Pezim, he's actually a big advocate for using market orders.
Oh, really?
To enter a trade, that is. If the price is within your calculated risk reward and the market's open, he says buy immediately.
Interesting. Why do you think he favors that approach?
I think Pezim really emphasizes minimizing emotional decision-making. By buying immediate, when your conditions are met, you're avoiding the temptation to, chase the price or hesitate.
Both of which can be really dangerous.
Oh, absolutely. They can lead to bad decisions and ultimately losses. But remember, this is just one approach, right? And what works best for you, that might be different. It's about evaluating your own trading style and your risk tolerance.
That's a good point. Okay, so we've talked about entries, but let's shift gears a little bit. Let's talk about getting out of a trade. After all, you haven't actually made any money until you sold.
You haven't locked in those gains. Couldn't agree more.
So how do you approach the exit?
Well, first things first, setting a stop-loss order. That's non-negotiable, like absolutely essential. It acts as your safety net, automatically exits the trade if it starts moving against you.
So it limits your potential losses.
Exactly. It prevents a small loss from turning into a big disaster.
Right. And then what about when a trade is going in your favor? How do you know when to take profits?
Well, you could set a simple profit limit order. Think of it as a reverse stop loss.
Yeah.
It automatically sells your position once the price hits that predetermined target you set.
So you're locking in those profits.
Yeah, you're not leaving it up to chance. But Pezim, he also talks about this scaling out strategy. Have you heard of that?
Yeah, I've heard the term, but I'm not entirely sure how it works. Can you break it down for us?
Yeah, so scaling out, it's about capturing profits at different points as the price is moving in your favor. Imagine you're harvesting crops.
Okay, I like where this is going.
You wouldn't wait for every single fruit to ripen at the same time, right?
No, you'd pick the ripe ones first.
Exactly. You'd pick the ones that are ready and let the others continue to grow. And scaling out, it lets you do something similar with your trades. You take some profit off the table while giving the rest of your position room to run.
So you're not putting all your eggs in one basket, so to speak.
Right, exactly. You're diversifying your exit points, really.
That's a really helpful analogy. But it brings up the question of how do you determine those different harvesting points? Like, how do you decide when to take those partial profits?
Well, there are a bunch of different methods. Some traders use technical indicators like moving averages or oscillators. Others might identify key support and resistance levels on the chart.
So it's all about finding what works best for your style and the specific stock you're trading.
Right, exactly. There's no one-size-fits-all approach, but you could even set price alerts, to notify you when a certain target is hit.
Ah, so you don't have to be glued to your screen all day.
Right, exactly. Let technology do some of the work for you.
So scaling out, it sounds like it involves a lot more active management, a lot more decision-making than just setting a single profit target.
It does, but that reflects the reality of swing trading, right?
Right.
Prices rarely move in a straight line.
Up and down all over the place.
Exactly.
Right.
And by scaling out, you're adapting, to those evolving market conditions and potentially maximizing your gains, all while managing risk.
It's like a dance.
Yeah, finding that rhythm.
Okay, and speaking of managing risk, Pazim also talks about adjusting your stop loss as you scale out of a trade. Now, why is that important?
So imagine this, right? You've entered a trade, you've taken some profit off the table. Now, you don't want the rest of your position to fall back below your initial entry point, wiping out those gains.
Right, you don't want to end up in the red after being in the green.
Exactly. By moving your stop loss upward, you're essentially protecting those profits you've already secured.
So even if the price reverses, you're still coming out ahead.
Exactly. You're locking in those gains as you go.
So it's like dynamically managing your risk and reward as the trade unfolds, securing those profits at each stage.
You got it. You're on the right track. And Pazim, he actually recommends scaling out at different speeds depending on the type of trade you're in. For plays based on support and resistance levels, he suggests taking full profits at your target and adjusting your stop loss to maintain a 1-to-2 risk-reward ratio.
So you're always limiting your downside while maximizing your potential upside.
Exactly. But for trades that are driven by strong momentum, like a breakout or a hot sector, he suggests scaling out more gradually, letting the trade run its course.
Don't kill the momentum too early.
Yeah. Let it ride the wave a little bit.
This is really making me think there's a lot more to exiting a trade than I initially realized. It's almost like a separate strategy in itself.
It is. It's not just about getting in. It's about knowing when and how to get out.
But before we delve deeper into that, I'm curious about something Pazim calls trailing stops.
Ah, yes. A very useful tool.
It sounds like another way to protect profits. Can you explain how those work?
Of course. A trailing stop, it's essentially a dynamic stop loss.
Dynamic, so it's not fixed.
Right. It automatically adjusts as the price moves in your favor. It basically trails behind the price, maintaining a predetermined distance. So, for example, let's say you buy a stock at $50 and you set a $5 trailing stop. If the price goes up to, let's say, $60, your trailing stop will automatically rise to $55.
So even if the price suddenly drops, you're still guaranteed to exit with at least a $5 profit per share.
Exactly. Yeah, it's a way to lock in profits as the price rises without having to constantly monitor the market. And a lot of brokerages, they offer trailing stops as a feature, so they're pretty easy to implement.
That sounds really useful, but I imagine there's a bit of an art to setting that trailing stop distance correctly, right? Like how do you avoid setting it too tight and getting stopped out by normal price fluctuations?
That's a good question, and that's where understanding the stock's volatility comes in. Pazim, he suggests using what's called the average true range, or ATR for short, as a guide.
Okay, remind me what ATR tells us about a stock.
Right, so the ATR, it essentially measures the average daily price range of a stock, over a specific period. A high ATR that suggests that the stock is more volatile, has a bigger price swings, whereas a lower ATR that indicates smoother price action.
Oh, that makes sense. So a volatile stock would need a wider trailing stop than a calmer stock.
Precisely. Yeah, you don't want to get shaken out by normal volatility. And Pazim, he actually recommends multiplying the ATR by 1.5 to get your trailing stop distance.
So for a stock with an ATR of, let's say, $2, you would set your trailing stop $3 below the current price.
Exactly. You're giving it some room to breathe.
Wow, this is a lot to take in. This is really fascinating stuff.
Yeah, it's a whole world of strategies and techniques.
I don't know about you, but I'm already feeling a lot more confident about managing my swing trading exits. But before we move on, I want to touch on something we mentioned earlier. It's this idea of adapting these strategies to your own trading style.
Yeah, absolutely. I mean, there's no one-size-fits-all approach in swing trading.
Mm.
What works for one trader might be a disaster for another.
So how can they figure out what works best for them?
It's a journey of self-discovery, really. You got to understand your own risk tolerance. How much can you handle seeing your account go up and down?
Yeah, that's a big one. Some people are more risk averse than others.
Right. And also your time commitment. How much time can you actually dedicate to watching the markets and managing your trades?
Because some of these strategies, they sound pretty active.
They can be.
Yeah.
And even your emotional responses,
Yeah.
How do you react when a trade is going against you? Do you panic and sell? Or do you stay calm and stick to your plan?
That's a tough one. It's easy to get emotional when you're dealing with real money.
It is. And that's why paper trading is so valuable. It's like a dress rehearsal. You can test out different strategies without risking any real capital. See what feels comfortable. See what actually gives you good results.
Yeah, it's like a safety net. You can practice your swing trading moves without the fear of falling.
Exactly. So what stood out to you most from Pazim's insights on entries and exits?
I think his emphasis on active management really resonated with me. It's not just about finding a good entry point and then sitting back passively.
Right. You're not
Yeah.
just buying and holding.
No, swing trading, it requires ongoing adjustments and decision-making throughout the life of the trade.
It's like navigating a ship through changing waters. You got to constantly adjust your course based on the winds and the currents.
I love that analogy. And speaking of active management, those trailing stops, they seem like a game changer.
Oh, they can be incredibly powerful.
Yeah.
They really can. Helping you protect those profits as the price goes up. But as we discussed, setting them appropriately, that's key.
Yeah, finding that sweet spot. You want to protect your profits, but you also don't want to get stopped out too early just because of normal price fluctuation.
Right. It's a delicate balance. What are your thoughts on using the ATR to determine the trailing stop distance? Have you found that to be reliable in your own trading?
I think it's a good starting point, but I also consider the specific characteristics of the stock and the overall market conditions. In a highly volatile market, I might use a wider trailing stop than I would in a calmer environment.
Right. Makes sense. Got to adapt to the market you're in.
Exactly. It's all about adapting. Now, I'm curious, what are some common pitfalls? What are some things that traders might encounter when it comes to entries and exits? What should our listeners be aware of?
Well, one of the most common mistakes I see is entering a trade too late.
Mm.
Chasing a stock that has already moved significantly higher. It's that FOMO, the fear of missing out. It's a powerful emotion.
Oh, it can be irresistible. You see everyone else making money and you just want to jump on that train.
Exactly. But often it leads to buying high and selling low, which is the opposite of what we want to do.
Yeah, you're chasing those parabolic moves, but it rarely ends well.
Rarely. Patience and discipline. They're your best friends in swing trading.
Absolutely. So entering too late, that's one pitfall. What else should traders be aware of?
Neglecting stop-loss orders or setting them too loosely. That's another big one.
Why do you think traders are sometimes hesitant to use stop losses?
I think it's often an emotional thing. It's like people don't want to admit that they could be wrong.
So they avoid setting a stop loss, hoping that the trade will magically turn around.
Exactly. But that's like driving a car without brakes.
Yeah.
It's essential. It's like your insurance policy. It protects your capital. It manages your risk. It should be non-negotiable.
Okay, so we've got entering too late, neglecting stop losses. Any other traps that traders should be aware of?
Exiting a trade too early, that's another one. Fear, impatience, they can lead traders to cash out before a move is fully played out.
They leave money on the table.
They do. It's like harvesting those crops before they've reached their full potential.
Give those winning trades some room to breathe.
Exactly. Let them ripen. But how do you balance that with the fear that the price might reverse?
Yeah, that's always a worry.
It is. And that's where trailing stops can be really helpful. They
Yeah.
allow you to ride that upward momentum while still protecting your gains, if the tide turns.
Now, I'm curious about the psychological aspects of trading. Are there any other emotional pitfalls that can sabotage a trader's entries and exits?
Oh, there are plenty. Revenge trading is a big one. It's when a trader experiences a loss and then they immediately jump back into the market, often with increased risk, trying to make up for those losses quickly.
So it's driven by emotion, not by logic.
Exactly, yeah.
Yeah.
It's emotional decision-making at its worst. And it often leads to a cycle of losses. It can really damage your account and your confidence. So it's crucial to acknowledge those emotions, to step away from the market if you need to, and come back with a clear head, with a well-defined plan.
So managing your emotions is just as important as managing your trades.
Absolutely. It's all connected.
This has been an incredibly insightful conversation. It's clear that swing trading is not just about technical analysis and chart pattern.
It's not. It's about the mental game. It's about discipline. It's about patience. It's about the ability to control your emotions in the face of market volatility.
It's about being a trader, not a gambler.
Well said. Couldn't agree more. And remember, this is just the beginning of your swing trading journey. There's always more to learn. There's always new strategies to explore. There's always ways to refine your approach. The key is to stay curious, to embrace that continuous learning, and to enjoy the process.
As always, thanks for joining us on this deep dive. And to our listeners, happy trading!
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.